Hey everyone, and welcome to this explainer, where we are going to completely demystify the core economic principles of running a business. Today, we're cutting through all the noise to explore the hidden costs that silently drain bank accounts, the absolute physical limits of production, and the harsh, sometimes brutal realities of scaling up your operations.
So let me ask you something. It's a foundational question for anyone running a business or even just thinking about starting one. Are you actually making a profit? I mean, really making a profit. Because what you see sitting in your bank account at the end of the month isn't always the whole truth. In fact, relying solely on that bank balance can be one of the most dangerous illusions in business.
To figure out what's really going on, we'll be following a clear roadmap today. First, we'll look at defining true business profit. Second, the short-run hustle. Third, scaling up or down. And fourth, the market battlefield. All right, let's jump right into section 1, defining true business profit and understanding what you're really making. Look, you already know your explicit costs, right? Those are the literal receipts for wages, leases, raw materials, the stuff you can easily track. But the silent killer of a business? Those are the implicit costs, the what-ifs. What if you'd invested your capital somewhere else? Or what if you were out earning a hefty salary working for another firm? These are your opportunity costs, and they completely change the entire math of your business.
Let's look at an example to make this concrete. We'll look at a company called Formet. According to their standard financial report, they brought in $1.1 million in total revenue. Great. When we deduct their explicit costs, which amount to $1,030,000, they're left with an accounting profit of $70,000. Now, if you're the owner, you're probably popping champagne right about now, thinking you've built this highly successful, profitable enterprise. But hold off on the champagne, because here is the crushing economic reality. When we calculate economic profit, we are forced to factor in those implicit opportunity costs we just talked about: a foregone salary, maybe foregone rent on a property you own, and foregone interest on your invested capital. For Formet, that adds up to $160,000 in lost opportunities. So when we subtract that from our accounting profit, Formet isn't making $70,000 at all. They are actually suffering a $90,000 economic loss. By choosing to run this business, the owner is literally 90 grand poorer than if they had just taken a job and invested their money elsewhere. Talk about a massive reality check, right? Reeling from that a bit, let's move on to section 2, the short-run hustle and how we work with fixed limits. In economics, time isn't really about the calendar, it's all about flexibility. The short run means you are stuck. Imagine you have a tiny restaurant kitchen. You can't magically stretch the physical walls, right? You have fixed inputs. The long run, on the other hand, is when you finally have the time and the capital to knock those walls down, buy a brand new building, and completely change your scale. But while you're stuck in that short run phase, you inevitably hit the law of diminishing returns. It's a classic too many cooks in the kitchen problem. Eventually, adding another worker into a fixed space doesn't just fail to help, it actually starts dragging down the overall productivity per worker. Just look at how Formet's marginal output absolutely plummets after employee number 4. The first few workers, they add a ton of value, but by the time Formet hires an 8th worker, that person adds literally 0 extra output. They aren't cooking anything. They're just bumping elbows with the rest of the staff in a cramped, fixed-size kitchen. It's totally inefficient. To survive this hustle, you can't just casually look at your total costs or basic averages. You have to obsess over marginal cost. That is the exact price tag of producing just one more unit. Because when your kitchen gets too crowded and those diminishing returns kick in, your marginal cost skyrockets, simply because each new meal is getting harder and harder to produce. Okay, let's break out of the short run and head to section 3, scaling up or down and navigating the long run curve. Once you finally have the time to change those fixed inputs and build whatever plant size you need, you're dealing with the long-run average cost curve. This kind of bathtub-shaped curve traces out the absolute most efficient path for your business as you grow. It's basically a map, helping you find the perfect sweet spot of production before your business gets way too large and clumsy to manage. So on the left side of this bathtub, you want to achieve economies of scale. That's where your average costs decline as you increase output, usually thanks to specialized labor and highly efficient equipment. But on the right side, a very real threat emerges. You absolutely must avoid diseconomies of scale. That's a dangerous zone where your average costs aggressively start to rise again as your firm swells in size. You might be wondering, why would getting bigger make you less efficient? Well, typically it's a symptom of growing bureaucracy. As a company swells, massive barriers to communication emerge. The left hand completely forgets what the right hand is doing. And this leads to chaotic management and coordination difficulties. The company simply becomes a giant ship that's too massive to steer efficiently, and your costs per unit start bleeding upward.
Now that we've got scaling figured out, let's head into our final section, Section 4, the market battlefield, to see where your business actually fits. Because your business doesn't operate in a vacuum, right? You are out there fighting on a specific market battlefield. And this ranges anywhere from perfect competition with tons of sellers through monopolistic competition into oligopolies, all the way down to a highly guarded, extremely difficult to enter monopoly. If you happen to operate in perfect competition, you're in for a brutal fight. You're up against a massive number of small firms, and you're all selling the exact same homogeneous products. And here's the kicker. Because it's so incredibly easy for new businesses to enter, the absolute second you start making a real economic profit, new rivals will flood the market, drive the prices down, and effortlessly steal your slice of the pie. So, knowing all this, knowing that your paper profits might be a complete illusion, that your physical space has absolute limits, and that growing too fast brings sheer corporate chaos, what is your next move? How are you going to adapt, outmaneuver the competition, and truly scale your business in this kind of economy? It's definitely a lot to think about.